It's Monday, October 12th. I'm your host, Jason Moser, and on this week's financial show, we've got a new war on cash credit card. Square is taking its relationship with Bitcoin to the next level. And in case you hadn't heard, it's Earnings Palooza Eve, people. The banks start reporting tomorrow, and we've got a couple of thoughts. Joining me this week, as always, certified financial planner, it's Mr. Matt Frankel. Matt, how's everything going?
Hey, good to see everybody. Hope you had a nice weekend. It's been rainy in South Carolina, but good weekend nevertheless. So.
Good weekend. Got some good football in there. It's October. Fall is in the air. This kicks off a really nice stretch of the year, I think. You know, you got October, November, December, 3 fun holidays, a lot of good food to eat. You know, you build a fire or two here. And I like this time of year a lot.
Me too. I think fall is my favorite if I had to pick a season.
Well, let's hope it just continues to be a good fall, and let's hope everybody out there is staying happy and healthy. It seems like we're hopefully closer to the end of all this chaos, but, we just keep on keeping on. Matt, we were talking about this a couple of weeks ago when we were discussing PayPal and all of the different types of things that PayPal has been doing with the business, the Honey acquisition, the different things it's doing in regard to digital and mobile wallet and whatnot. And PayPal came out with some news here recently in regard to the Venmo side of the business. The company, they're introducing a Venmo credit card. It's something that will be in partnership with Synchrony Bank, which is obviously a longtime partner of PayPal's. Venmo, as we know, is a part of PayPal's business when they made that Braintree acquisition. It's a credit card. I know this probably isn't a big driver for the business, at least today, but in reading through all of the nuts and bolts of this deal, of this product here, I really do like the move. It feels like it creates yet another reason to be in that PayPal universe.
Yeah, well, for one, I think this is a win for Synchrony before we actually get into PayPal.
Well, I like that angle too.
Synchrony is, as you know, they're the big store credit card company, and they're the issuer of the PayPal credit card. But being honest, Venmo's cooler than just PayPal. It just is. And this card, what really struck me about the card was the rewards structure. It's a 3% cash back rate in one of 8 spending categories. But the cool thing about it is it's whatever spending category you use most. It's not like these cards. It's not like the rotating categories or where you only get the best rate on gas and groceries if you don't even use the card for that.
Yeah, and they're not like trying to push you into some sort of consumer behavior. They're just rewarding you for your behavior that you just kind of do every day.
Right, and it's 3% back on your most used category, 2% back on the category you use the second most. And just looking at it, it's groceries, bills and utilities, health and beauty, gas, entertainment, dining and nightlife, transportation, and travel. So if you get the Venmo credit, if you want a credit card that gives you 3% back on travel, get the Venmo card and use it exclusively for travel.
Yeah,
it's a lot of optionality for the customer, which is really nice, and I think that's going to be the edge. So I think this is a win both for Venmo users and for Synchrony.
Yeah, I tend to agree, and it's a Visa card, if we didn't mention that. So, those are the 3 players in that value chain, so to speak. You've got Visa, Synchrony, and PayPal. The other thing I found interesting about this card, and this sort of couples with PayPal's recent tie-up with CVS, right? They recently forged a relationship with CVS to display the QR code in CVS stores. And, the QR code, it's yet another way to really implement that mobile payment system, right? That's where you can actually scan that QR code and it makes things essentially... It makes things operate more quickly, right? You get from point A to point B, I think, just a little bit more quickly. And in the case of the card, they're going to actually put the QR code on the front of the physical credit card. The physical credit card still has a place in this world. I know that some people like to think, oh, I can just pay with my phone. The fact of the matter is, if you're going to pay for something, you're going to pay with your phone or you're going to pay with your card. But either way, you've got to get something out to make that payment, right? There's still that point of friction. So, we've seen where Amazon is trying to fiddle around with, being able to just kind of show your hand, right? They wave your hand and make that payment. And hopefully that's technology that continues to develop and one day maybe take mainstream adoption, but we're not there yet, obviously. But I do feel like having that QR code, that's something that's very much in touch with the younger audience that uses Venmo to begin with, which kind of goes back to that point that you made. I mean, I know that was a little bit tongue in cheek, but really it was spot on. Venmo is really, I think, perceived as being cooler than the PayPal brand.
It is for sure, and the QR codes definitely help. It makes things easier. Like for example, if you're paying the bill and you're with six of your friends, you take your Venmo credit card out to pay the bill. They all take their phones out, scan your QR code, and send you money.
Exactly.
This way you don't have to physically pull up your QR code while you're trying to pay the check with your credit card. It's just it makes things less complicated, especially like you said for today's consumers. I mean, I don't even know if I have six friends anymore, but back when I did, splitting the bill splitting the bill was a chore. You had to sit there and everyone had to get change, and it was a pain. But and this kind of simplifies an already simplified process by Venmo even a step further, I think.
Center of controversy there, are you, Matt? You just, scaring those friends away, are you?
No, did you have friends when you had a 4 and a 2-year-old? I mean, I certainly don't.
I guess that's a good point. I guess technically I have them. I just don't really
Yeah,
see them
there you
as
go.
often as I do. But you get to that, you get down the road, they get a little bit older, and they can become a little bit more self sufficient, and life kind of takes a little bit of a turn back into that direction that you're more familiar with. So just hang in, hang in there. All right, well, let's talk a little bit about Square, because this is funny. We didn't plan this, but this really did turn out to be kind of a War on Cash themed show here. You've got PayPal with the Visa credit card. Now we're talking about Square. This is a little bit of a different story here, and I want you to convince me this is a big deal, because I'm not really sure that it is. But the fact of the matter is that Square has taken its relationship, its belief in Bitcoin to the next level. Not a surprise. We know Jack Dorsey's a big crypto evangelist. We know he believes in that, and it's a way to democratize finance. But now, I mean, Square is going to hold, I think it's $50 million worth of Bitcoin on their balance sheet. Is this really a big deal, though?
Kind of. I'm going to make a very unpopular statement right now. Square's interest in Bitcoin is my least favorite part of the company.
Ah,
Um,
I mean,
a- as an
I think I'd
investor,
agree with you there. I think actually I agree with you there.
I mean, as an investor, I like to say that I bought Square before it was cool to buy Square. I mean, I got it, right after the IPO when everyone hated the idea of that it was going to go anywhere. But anyway, the $50 million of Bitcoin, it's roughly 1% of Square's total assets. So this isn't an insignificant amount of money that they're stashing in Bitcoin. I mean, this is money that was, sitting in cash anyway on their balance sheet. So it's just kind of moving from, it would be the same in my mind right now if they said we're going to hold $50 million in euro on the balance sheet. But it does kind of add a next step to their interest in Bitcoin. We know that that Square allowed people to start buying Bitcoin through the Cash App in 2018. Since then, they launched a Square crypto division that kind of focuses on solving Bitcoin related issues. They're participating in a few other nonprofit initiatives when it comes to crypto. But it's always been more of a business function, not that Square was directly investing in it. They were letting their users buy Bitcoin. They were trying to figure out how best to use cryptocurrency to solve future problems. They didn't actually think of it as an investment. This is maybe the biggest investor I know of or the biggest company I know of that's actually calling Bitcoin an investment.
So I wonder. I think about several years back when Bitcoin really was just starting to gain headline share there. We're talking about the big challenges for Bitcoin, between the two big challenges as a medium of exchange and a store of value. And I mean, you could see there were hurdles to clear on both sides there. Now, I think that the medium of exchange hurdle I'm still not convinced. I mean, I don't know. The mass majority of people out there aren't using Bitcoin to buy anything. It does seem to me, though, that it's starting to make its case a little bit more as a store of value. I mean, this to me for Square strikes me as more of a hedging strategy than maybe anything else. And maybe it's a way to, gain a little bit more headline share. Maybe it's a way for Jack Dorsey to get folks to believe a little bit more in the merits, the potential of cryptocurrency, Bitcoin, whatnot. So maybe it's a multi-serving move there, but it does seem to me, at least, it seems to bolster the argument that Bitcoin does hold a place in that store of value argument.
Yeah, and I would say over the last year or so, the price of Bitcoin has stabilized significantly. I don't know if you remember a couple of years ago when, 1 month it would be worth, 4,000, the next month it would be 20,000, the next month it would be 3,000. Who wants to store value in something that's going to do that?
Well, yeah, that's exactly right.
But Bitcoin's been roughly $10,000 for a pretty long time now. As I mean, give or take. I mean, it fluctuates just like any type of currency. But now it's behaving more like a currency rather than, just a crazy speculative asset. So if in that regard, I could also say it's more of a store of value. That's why I say right now, this move to put $50 million in Bitcoin, to me, isn't that much different than them putting it in euro or something like that from a financial point of view, because now the values become a whole lot more predictable.
Yeah, that makes a lot of sense. Well, as we mentioned at the top of the show, it is Earnings Palooza Eve, and that is officially a holiday, people. I mean, you got to know, 4 times a year, Earnings Palooza Eve is something we celebrate. It's exciting. We get amped up for this because it means we have about a month ahead of us to not only dig into all of our favorite businesses, but we're gonna have fun stories to talk about as well. And that's always, for investor nerds like us. I mean, that really is that's nirvana, so to speak, right? We're just at one with everything once Earnings Palooza hits. But first up here is Earnings Palooza does kick off. It's really the big banks that get it started, and so for us here on the Financial Show, that's a point where we can talk about what we're looking for from these banks as they report earnings. And it's been a difficult time, obviously, for banks, particularly smaller banks, I would say, just from the sense that the interest rate environment is so. I mean, it's almost non-existent. Interest rates are so low. At least big banks are big, and they can offset some of those challenges with their scale. But the banks that we typically focus on as these earnings reports start rolling out, Matt, we talk about Wells Fargo, we talk about Bank of America, which I know you're a big fan of. Goldman Sachs, another one we talk a lot about on this show. What are some of the things that you're looking for from these banks as these reports start rolling out this week?
Well, one, just as a general theme, it's not as much about interest rates right now as it is about loan losses. Banks can make money in low interest environments. I mean, if you go for an auto loan at, say, Wells Fargo right now, it's not going to be 0%. It's going to be, you're still going to pay them, 3, 4, 5% interest depending on your credit. So they can still make money in low interest environments. Remember, rates were around zero from the end of the financial crisis for the next, 6, 7 years, and banks were making money. So that's not the big issue. The issue is, how will the economic fallout from the COVID pandemic impact loan losses? Just in the second quarter alone, I'll start with Wells Fargo. In the second quarter alone, Wells Fargo set aside over $8 billion in anticipation of loan losses. Now, at the time, remember, the $600 unemployment boost was still in effect. Pretty much everyone thought that would be extended in some form. It's yet to be done. So that $8 billion might not be enough if things go wrong. Unemployment has decreased quicker than we would have anticipated, but at the same time, the help coming to the people who are unemployed has gone away. So the real key thing to watch, especially with Wells Fargo, which Wells Fargo is purely a commercial bank for the most part. They have a small investment banking operation, but for the most part, they make money off of consumers and businesses. So watch the loan loss ratio. I think their net charge-off rate was 0.46% in the second quarter. That's a key number to watch and see how it ticks up in the third quarter, because now we're going to really start seeing what the economic effects of the pandemic have been. There are some effects, but it's a question of just how bad it's going to happen. And remember, Wells Fargo was the only of the big banks to slash their dividend recently.
Yeah, that's right.
They need profits to bring it back. I think the formula has to do with the last 4 quarters of earnings. Wells Fargo produced a pretty big loss in the second quarter. So, I mean, normally I don't pay that much attention to the bottom line number, but in Wells Fargo's case, it's kind of important because it's where their dividends come from. now more than ever. And now they really have to be able to justify their dividends. So that's Wells Fargo, what I'm watching. Goldman Sachs is kind of the other end of the banking spectrum, meaning that it's almost exclusively an investment bank. There's some consumer banking, like the Marcus platform, Apple Card, things like that. But Goldman Sachs, for the most part, is an investment bank. And investment banks do better when the market's kind of going crazy, like it was in the second quarter. Yeah, the second quarter was their second highest revenue ever for a quarter. It was their highest investment banking revenue ever for a quarter.
And we've seen a lot of IPOs here recently too. That activity has picked back up a little bit. I mean that can't be bad for a bank like Goldman Sachs.
No, and that's part of the investment banking revenue. They had record equity underwriting revenue, which is IPOs, in the second quarter. Trading revenue was the highest it's been since the financial crisis. Now, I'm expecting Goldman's earnings to kind of take a breather during the third quarter. The third quarter was not nearly as crazy as the second one was when it comes to how the market was reacting. Thankfully, the April and May drama in the market only happened once. um, so that didn't happen. That didn't repeat itself in the third quarter to any meaningful extent. So I'm expecting the volatility related benefits to kind of taper off. But as you just mentioned, the one thing I do want to watch is the IPO or the equity and debt underwriting even of the investment banking division should be pretty strong. So those are like the two ends of the spectrum. And then Bank of America is a nice combination of the two. Nothing really particular I'm watching, but a lot of the big banks, Bank of America is not the only one. JP Morgan Chase is another, Citigroup, that have a nice combination of consumer and investment banking. So I'd like to see how those really hold up.
Yeah, Bank of America is one. I mean, I feel like we talk about this every quarter, but it just never ceases to amaze me how the conversation over time has changed with this company. I mean, it went from, I mean, just a pariah to really one of the leaders in the space in just a short period of time. I mean, it did feel like every day years ago that every day there was a new headline that was that was not working in their favor, and you fast forward to today. Clearly, the focus on the consumer remains. The presence in investment banking is strong, and then it doesn't hurt their cause that Wells Fargo has kind of taken their place as the major financial institution that just seems to just step in it day after day now, right? I mean, that's it seems like they've really kind of traded places.
Yeah, I mean, it's really weird how the orders kind of shifted. When
Yeah.
you think of the big four banks, it used to be J.P. Morgan Chase and Wells Fargo battling for that number one position, and you could usually make the case it was Wells Fargo when it came to profitability and efficiency and things like that. So those were the one and two, and then you had Citigroup and Bank of America kind of battling for the last place. And now Citigroup's a firm third place, and Wells Fargo's all the way in fourth. And I would say it's J.P. Morgan and Bank of America kind of jockeying for that first place spot. I mean, J.P. Morgan Chase is a more profitable and efficient institution than Bank of America right now. They're also a lot more expensive when it comes to like price to book. So, I mean, I can make the case that Bank of America is the best investment in of the big four banks right now.
Well,
But
I think a lot of people would listen.
but on Friday, when we've heard from all of these big banks, who knows what's going to happen? I mean, Wells Fargo could have lost $15 billion or $3 billion. We don't know, and if it was only $3 billion, that means they set aside $5 billion too many, and that goes back into investors' pockets at some point. So I mean, it's too early. There's a lot that could happen this week. It's going to be an normally exciting and bank earnings don't really go in the same sentence, but
Well,
this week,
we're changing the conversation. We're changing it up here.
right? So it'll be an interesting week.
What do you think? We saw the news last week. Speaking of big banks, and one that we don't talk about a whole heck of a lot, but I think some news that was at least noteworthy here: Morgan Stanley acquiring Eaton Vance, and this we talk a lot about consolidation in the space. I mean, this is certainly an effort from Morgan Stanley to boost that investment wing of the business. I mean, Eaton Vance holds somewhere in the neighborhood of $500 billion in assets under management. I mean, this is from the perspective of Morgan Stanley, not the biggest deal in the world. I mean, Morgan Stanley is a considerably larger business, but it's not just some little bolt-on acquisition either. Any thoughts there?
Well, I not to brag or anything, but a couple weeks ago when you said what trend are you watching in the rest of 2020 in banking, I said consolidation in the brokerage space.
Well, then brag a little bit by all means, Matt. That's one of the reasons why we're here, right? Talk your
Well,
own book.
I didn't mention Eaton Vance. I mean, that was one I really didn't think was going to get bought out. I thought someone would acquire like a Robinhood or something like that to get more techie, I guess you'd say, and appeal to the millennial crowd. But remember, Morgan Stanley just acquired E-Trade. Like that just happened. So they're really making a big push to scale up their business. And from that perspective, when you combine their existing clientele, which off the top of my head, I don't know how much assets Morgan Stanley already had, but I have to say it's over $1 trillion. And then combine that with all the E-Trade retail brokerage assets and the $500 billion of Eaton Vance wealth management assets, all of a sudden you have a much more scaled and potentially profitable business. So I said that a couple episodes ago, like I mentioned, that consolidation was something to watch. And the reason is because, fees are coming down. The way you're going to make your money is through scale and efficiency. Among other, I mean, brokers have other ways they make money. But, I mean, even though TD Ameritrade's commissions went to zero, that didn't mean they were going broke. But this is going to be a long-tailed trend, I think, in the space. I still think somebody's going to step in and acquire Robinhood.
I think I think I would probably put money on that as well. At some point, I mean, there were a couple of things. I mean, to your point there, I mean, this acquisition, Morgan Stanley is going to oversee close to $4.5 trillion of client assets across all of its wealth management divisions, which is that's obviously an astounding number. I think it's interesting too. This will give them a bit more of a presence in the ESG space, right? That's obviously a direction where a lot of these firms are headed. A bigger focus on ESG investing, and rightly so. I think that is going to be something that just becomes more important as time goes on for investors. But then there was a telling quote from Morgan Stanley CEO James Corman. He said in an interview, I quote, "It was sort of obvious if we didn't do this, someone else would have." And that really, I think, says it all right there. They've been thinking about this for a while and really kind of came to the conclusion that this deal had to happen.
Yeah, I mean, it was kind of the same, in my mind, the same reason Schwab acquired Ameritrade. Just because, like you said, if they didn't do it, someone else would have. It's a powerful franchise. They were one of the, in according to many lists, the top rated broker in terms of functionality and stuff like that. So it's just, when commissions went to zero, it's just a matter of time before there's this kind of like land grab for all the smaller firms, including the ones that were already doing zero commission, like Robinhood. I could see a company like Square buying them out.
Yeah, and we talked about that before for sure.
Or even PayPal. Maybe they do brokerage in their Venmo app.
Yeah, that would be an interesting idea there because that certainly would pivot away from what PayPal has been so focused on, wouldn't it?
Yeah, but I mean, Venmo. I mean, I wouldn't call PayPal and Square direct competitors in most ways, but in terms of the Venmo and Cash App thing, they're pretty close.
Yeah.
In
Yeah.
terms of,
Oh,
I couldn't tell for a second if that was you or me.
no, that's not me. That's my dog. Sorry, folks. That's
Well, not you personally.
the the challenges of working from home. Anyway, let's before we wrap up here, Matt. One thing I did want to bring up because this is not really directly related to Berkshire Hathaway, but this was a headline that hit this morning, which I thought was pretty fascinating. Dillard's. I mean, the old department store from the mall. I mean, we talked about the challenges malls are facing. I mean, it was very interesting to see this news that Ted Weschler, who's an investment manager for of course Berkshire Hathaway, bought a massive stake in Dillard's. And Dillard's stock up around 40% right now in this news. Now it's not a Berkshire Hathaway investment though, from what I can understand. This is a Ted Weschler investment, correct?
It is, and that's what makes it all the more surprising. I wouldn't really put it past Buffett to do like a deep value play like this. But the Ted Weschler and Todd Combs, the two investment managers, they're the ones who buy Amazon and Snowflake and StoneCo and those type of companies recently. They're not buying Coca-Cola and Amex like Buffett is. They're buying the tech plays. So it kind of surprises me. I mean, it's definitely a value play in my mind. The thing that I obviously no one knows what he's thinking, but I one thing that came to my mind is that maybe it's kind of like the Best Buy effect. When you think of Best Buy 10 years ago, they had Circuit City competing against them, H Gregg, a few other big ones. What happened? The weaker competitors went out of business. And even though Best Buy was competing with Amazon and e-commerce, there was still some need for a physical electronics store presence. So they picked up all that market share that Circuit City and Gregg left behind. And now they're that much stronger as a result. So Dillard's is, I mean, no department store is terribly strong right now. But I would put Dillard's obviously in a category above like JCPenney, which is already bankrupt, but even above like a Macy's or some of the other ones. But I mean, Dillard's seems to be doing better than all of its peers. So I'm thinking maybe he's thinking it might be like a last man standing type of play. I don't know. What are your thoughts on that?
Just to me, it's difficult to really fully reconcile. I mean, I always look at something like this and I feel like, you know what, these guys have access to a lot more information, and they're certainly very talented, very smart investors. There's clearly something there that we maybe can't see based on information that they have. I don't know that. I mean, it reminds me of the Buffett Bank of America deal, right? This is probably something. This is something where they're able to do something through this investment that your typical retail investor probably wouldn't be able to accomplish. And maybe
right.
It works
I
out,
wouldn't
maybe
be
it
surprised
doesn't.
if he got a board seat or something like that out of the deal.
Right, exactly, and I mean, and maybe that is something. Maybe that is something to come. But I think it's easy to look at that big absolute number and think that's a big absolute number. But remember, I mean, they're dealing with big numbers every day, and so for them, I mean, it's not necessarily as crazy of a at least on the outside, it's not necessarily as crazy of a looking at investment as maybe some might think. It's a really difficult time for those department stores and malls and retailers right now. So maybe this is trying to buy a good operator in a bad time, and I certainly appreciate that style of investing and that way of thinking. So it'll be really fun to watch that play out and to see how that ends up working. I don't think Dillard's is some kind of a Sears story, though. I think there's probably some value there that he could end up helping to wring out a little bit more value.
Well, I mean, that's the same reason I bought Simon Property Group. It's not because I necessarily think malls are a great business right now. It's that they're the best in breed, and I think that it's going to consolidate around them, and they're going to kind of be the wave of the future when this is all said and done. Not necessarily that I think the mall business is a great one to be in right now, just like the department store business is clearly not a great one to be in right now. But I don't know, maybe he knows something there, like you said.
Yeah, I tend to approach it from that perspective. And just an update here to confirm. Apparently, that was my dog taking the other side of the consolidation argument there, the consolidation case. So I don't know. I'm with you. I am bullish on the consolidation case. Apparently, Wally is not. We'll see how that plays out. I have a feeling that we're going to be rubbing that in Wally's face here soon enough, though. But Matt, I think that's gonna take care of it. I think for us this week, and I appreciate as always you taking the time to tune in and to join us on Zoom and the show here. It's always fun catching up with you, and I'm really excited to see how all this stuff plays out for earnings season. And I feel like we know exactly what we'll be talking about next Monday.
I can already see it happening. Who knows what's going to happen, but I know what the topic will be.
We will be watching closely. Have a great week, buddy. And for us, that's going to do it this week, folks. Remember, you can always reach out to us on Twitter at MF Industry Focus. You can also drop us an email at industryfocus@fool.com. As always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against, so don't buy or sell stocks based solely on what you hear. Thanks, as always, to Tim Sparks for putting the show together. For Matt Frankel, I'm Jason Moser. Thanks for listening, and we'll see you next week.